We've zeroed in on 4 big trends we think are going to power the market in 2026 and found one chart for each of them.
And they also tell you why the stock market will continue to be a bull market through 2026, unlike the contrarians say, we are not in a bubble.
We talk into big issues like what's happening in the utility market and what does that mean for elections, whether or not you need to panic the first pullback you see in the market, and also what's going on for interest rates and how that could be a kick save for the consumer, and also big geopolitical issues. And on top of that, if you hang out to the end, we also talk about 2 companies we think are going to be big beneficiaries of these trends also today on Altimetry Authority.
Stock earnings and favorite pastime.
So let me just say, earnings
stupidity
work
of Wall Street.
That's
2.5x
because their compensation goes up.
Wall Street's wrong again.
So Joel, as we look towards the end of the year, you and I both thought we'd do something a little cheesy, but a little valuable for everybody, which is everybody is always making their best of list. We thought we'd make everybody a best of 2026 list and give you all the playbook that we think is going to play out. And really not the playbook necessarily, but the 4 charts we think are going to be most important to understand where 2026 goes. And so with that, this will be a bit different in terms of a format from what we normally do. The first chart that we're going to talk about is the chart that is destined to decide the election. This chart is a map. It is a map of the United States and a map of what is happening to the United States and what already has happened in the last 5 years, which is only going to get worse over the next year, which is in the last 5 years, there are many places in the United States where the cost of power has gone up 100% or more. In Buffalo, up 200%. In Baltimore, up 150%. In Columbus, Ohio, price of power, your utility bill, cost per kilowatt hour has gone up 110%. And why is this important? Because the story of this election that's going to play out in the back half of 2026 is going to be a story of what we're already hearing people start to talk about, affordability, but it's not about price at the pump or anywhere else. It's about price at the meter. And the fact that people are really starting to feel the pain because of the fact that we are seeing power prices go up because of AI data center usage, and not just AI data center usage, also everybody, because of what's going on in terms of the reindustrialization of America. And if we don't get this figured out, what we're going to see happen is we're going to see a wave of changes in terms of the House of Representatives and the Senate, because people are going to be unhappy. We're already starting to see it crop up a little bit in terms of local elections in conversations about data centers. But because of this, way before the election, we are going to see 2 big things starting to happen more and more. We are going to see as much investment in power infrastructure and energy infrastructure as you can imagine as we try to break ground so we can get more power plants online to start solving this issue. But also, we're going to see more and more of a narrative of the AI data centers going behind the meter in terms of buying their power, meaning that they're going to start to try to figure out more and more, working with companies like Bloom Energy, working like companies like Ormat for geothermal and everywhere else, to figure out how do they get power plants that are just producing for them as opposed to taxing the grid. And if you don't pay attention to this and what this means for the AI energy ecosystem build out and what that's going to do to fuel a continued massive investment growth, you're just totally missing the chart here.
To solve the electricity, what is going to be an electricity crisis, and I'd argue already is. It's funny that the politicians haven't been talking about it more, because they want to talk about eggs being up, in cost 30, 40%. Well, they went up and it come back down, or the cost of beef. But when your electricity bill is up 3 times, right? Triple. In fact, the only place in the country where the electric bill isn't up are the places that are co-located to natural gas pipelines where they can make the electricity super cheap from natural gas, which actually tells you what the answer is in the short term is we need to have a massive amount of natural gas built, natural gas driven electric facilities. Otherwise, you're going to see this price of electricity go up even more across the country. And long term, the only answer is nuclear. The only answer is nuclear. So without natural gas in the midterm, short to midterm, and nuclear in the long term, solar just can't do it. The problem with solar and wind and whatever is it's just too fickle based on sunlight, the weather, the time of year, the climate, what have you, versus natural gas that you can just be always on all the time, and nuclear always on all the time, powering that baseload capacity of what anybody needs, and frankly, very inexpensively once the infrastructure goes in. that said, if we don't see that, you're going to see electric bills get even higher. And you're going to see a lot of Congress people talking about saving their jobs by saying they're going to bring down the cost of electricity, because every time someone talks about inflation or affordability, that's the big one. That's the big one that you're going to start seeing hit even harder through 2026.
Exactly. All right, everybody. The next chart that we think is an important chart to know when we go into 2026 is a chart that reminds you that diamond hands, as the Wall Street bets people would say, are going to be worth their weight in whatever it is. Titanium, probably not diamonds, because diamonds are worth a lot less than they used to be. You know, all those fake diamonds.
Lab-grown diamonds are not fake diamonds, Rob. Lab-grown diamonds are real diamonds. They're chemically the identical.
They're real
There's no
diamonds.
difference in a
It's
lab-grown
true.
diamond and a real diamond. I'm sorry. That is why
It's
the cost
true.
of diamonds are coming down, because they aren't fake. That's the whole point.
It's true. It's fair. Yes, they aren't fake diamonds. The diamond industry wants you to believe that they are fake because it hurts the pricing power of the diamond industry. By the way, diamond hands are going to be worth a lot more than lab-grown diamonds cost you to be able to make. And the reason why it's important to know is because of this chart right here. So this chart, when everybody looks at this chart, you probably see, what you really see is you see starting at 0% in 1994 and going up to 600%. And you think, well, that's great. That would be an awesome investment opportunity to be able to experience the 1990s all over again, which is, by the way, what we think that we're in the midst of right now. Another technology adoption cycle boom, investment boom going on. But the thing that people sometimes don't pay attention to in terms of this is this. There were 1, 2, 3, 4, 5, 6, 7, 8, 9, 10% pullbacks in this up 600% market. And why is that important? Because in any big bull market, you are going to have growth scares, right? You are going to have pullbacks. And we can almost guarantee you that we'll have at least one, if not two, of these 10% pullbacks in 2026. It is absolutely going to happen because no big investment trend or any trend in investing or in the world ever happens linearly. And people are going to get spooked at some point, and you are going to see a real tangible investment, real tangible pullback. The reason why we're showing you this chart is to remind you, as long as the credit environment hasn't changed, and we will update you every single week about that here on the Altimetry Authority show, as long as we don't see that change, this is a buying opportunity. When you see that pullback, it is not a reason to panic, because the fact that when you see that pullback happen, and you know, people who are Altimetry Authority viewers, you've seen this chart many, many times from Joel and I talking about it. The reason why we always come back to it is when you see that pullback, what our research shows is you buy prior leadership. You buy prior leadership because that leadership, if the investment trend is still continuing, keeps on going on and on going forward. And so don't panic when you see that pullback happen, because there will be at least one, if not two. I mean, in 1999, there were 4 different 10% pullbacks before the market doubled in the back half of the year into 2000. So everybody keep that in mind. This chart will almost be arguably the most important chart for you to remember as an investor, because it's all about time in the market, not timing the market. Don't get cute trying to figure out how you can navigate in and out of the market. In the middle of an investment bull cycle like this, you want to own the market and buy leadership in any pullback.
And just to make a point for all the trolls out there, because I know I'm going to get trolled in this statement, so I just have a request of all the trolls, right? We are in the middle of this bull market cycle, not at the end of it. And anyone that says the stock market is in a bubble right now, please, for goodness sake, send me the data. Send me the data that's saying it, because I have so many people trolling me, and I'm sorry that you are, right, trolling me and saying, "Oh, you're crazy." I'm like, okay, now tell me why I'm crazy, right? Give me the article, give me the data, give me the research that you're showing that says we're in a bubble right now, other than the media simply repeating it to each other in this echo chamber of nonsense data. Garbage in, garbage out. Every time someone said we're in a bubble, they're like, "Oh, the PE is 40." I'm like, no, it's not. That's under GAAP accounting. Under uniform accounting, the PE is something like 23, 24 times. Oh, because earnings is falling. No, it isn't. Earnings is rising. The problem is investment is up, and the accountants miscalculate what is investment and what is actual profit. And they're making it look like companies are less profitable, and they're not. They're more profitable, and they're investing more. Well, that's what you want in a sign, right? And then this idea about, you know, interest rates. Interest rates are falling. They said, oh, but Powell has intimated on the last call that over the next several months, he's not going to lower interest rates anymore. Yeah, I go, yeah, because he only has several months left, because come May, there's a new game in town, right? And there's a new sheriff in town, and that's going to be whoever Trump appoints, and interest rates are going to come down even more. So please, if you're going to troll me on this whole, we're in a bubble and we're crazy, tell us why you think we're crazy so we can respond and answer in the next show, because I want to. The problem is we haven't found any data that's good data that backs up that we really are in a bubble right now versus we're right in the middle of this bull market. We're not at the tail end of it. We've got long legs to go. This is more like 96, 97 going to 2000. This is not 99 or 2000, which people keep saying it's like 99, 2000. It's just nonsense. It's nonsense on so many accounts if you have good data. So please, if you feel, if you're going to say we're crazy, say it, but tell me why you think it's crazy. All right? And don't just some crazy platitude that you heard from some mainstream media source that also doesn't have any research to back it up. Sorry, Rob. No more soapbox.
No, 100%. And that's the reason why you'll notice, everybody, if you pay attention, we always use the phrase boom. We don't use the phrase bubble, because we'll use the phrase bubble when we're in the bubble, but we are definitely not yet in the bubble. And Joel, your soapbox does help in terms of getting the transition to something else, which is May 15th, 2026, everybody, is the day that has the potential to kick save for the consumer. Why is that? Because May 15th, as Joel mentioned, is when we get a new Fed chair. And many people have said, hold on, right? I mean, again, Joel, to your point in terms of in the comments, right? I've seen more than once in our comments, people saying, why are they talking about Trump having any control with interest rates? Because if the Fed is independent, he doesn't. That has been the case historically. However, if you look at what Trump is doing in terms of who he is choosing to appoint for Fed governors, who is choosing to appoint for the Fed chair, and where the actual math is going, Trump is going to get his way on where interest rates are, because he does actually get to control those kind of voices in the Fed. And also he and Bissett are talking about other ways if they don't get their way to actually control the voice of the Fed. But what does that mean? On May 15th, we get a new Fed chair, and Trump has said he wants that Fed chair to aggressively cut interest rates. Why does that matter? Well, it matters because of this chart. And I know this chart doesn't seem like it should have anything to do with interest rates, but what this chart is, everybody, is the weight of different sectors, right? From technology to finance to healthcare to utilities to energy to consumer in the S&P 500 over the last 30 years. And one thing that should jump out to you, of course, the one that you're going to notice that's the most obvious one because it's the biggest bar, is that technology companies are a huge, huge, huge bar right now. There are reasons for that. But the really interesting thing is this, right? The consumer is currently 15% of S&P 500 market cap. That is by far the smallest percentage that it has been as a percentage of S&P 500 market cap in the last 30 years. And there is a reason for this. Obviously, I mean, you look at the consumer is seriously under stress. I mean, the consumer has issues in terms of affordability that we've talked about. The consumer is starting to see job growth get weaker and unemployment rates creep up. We've got serious debt issues with consumers. Delinquency rates in car loans, in auto loans, in student loans that they're finally having to pay are starting to creep up. There's a bunch of reasons why the consumer is under pressure, and this should be really, really small. But if you want to talk about who benefits from you cutting interest rates from 4.5% down to 2%, 1.5%, even 2.5%, sure, the AI boom is really going to benefit from that. But also consumers are going to have a sliver of a chance to have a little more room to operate. That interest rate cut is not going to solve it for consumers. Consumers still have a lot of pain to have, but it is actually going to be able to help them a lot.
And just I want you to think, in the life of a consumer, what are the two biggest spends a consumer has in their life? Generally speaking, house and car. And how many people buy house and car with cash? Most people buy house and car with financing. So when the cost of financing falls, two of the biggest problems that people are looking at right now, right, is the housing sector and autos. When you think about consumer, the two biggest spends that a consumer has in their lifetime are often house and cars, not just one car, but several cars. So house or several houses and cars, and those are financed. And if you bring interest rates down by the level that whatever new Fed governor is going to do come Fed head is going to come in May of 2026 when Trump gets to appoint that person, you're going to have a boom in that area. And so we think there's as Rob says, a kickstart, a kick save to the consumer and the consumer sector, and that may bode very, very well for that section of the stock market.
Yeah, and everybody, I mean, we already saw this happen with one part of the market just in this quarter, right? I mean, so in Q4, I think it's small cap and mid cap healthcare and specifically biotech and pharma are up like 20% when the market as a whole is up like 3 or 4%. And part of the reason why has been regulatory, and part of the reason has been because M&A has finally started to come back, but nobody was talking about the healthcare sector before the back half, before really all this got kicked off, because everybody forgot that, oh, that could happen. A sector that's really, really beat up, that also has just needs a little bit of room to breathe, could do it. We would be amazed if we don't see a story like that start to crop up with the consumer at some point in the first half of 2026 because of this issue in particular. So keep your eyes on that trend and what it means in terms of interest rates and the consumer.
With that said, the entire stock market benefits from lower interest rates because at the end of the day, every company's valuation, bar none, is based on a discounted cash flow of how much capital you put in and how much cash flow is generated on that capital the company puts in. And the cost of capital, which is driven by interest rates, when that gets less, that means the value of your cash flow is worth more. All right? There is worth more. And so there isn't, a company, I mean, the entire stock market benefits from this, but watch for how you might see a kickstart to the consumer as well.
Exactly. And now, Joel, let's talk about chart number 4, which is all about a bit of a different area. It's a bit of a geopolitics, which we know you love to talk about, US vs China, US vs Russia. Let's jump in on what this last fourth chart is and what it means for, geopolitical risk and how it could shake out.
Right. When we look at U.S. economic profit, this is corporate America, 3,500 companies. You're getting 99% of the U.S. stock market by looking at 3,500 companies, maybe even higher than that. And it shows that U.S. companies have been on a tear of economic profit creation, right? Going back to 2005 to 2009, even in 2009, it still wasn't that bad a year. But now we're looking at $1.6 trillion in economic profit being driven. You have to use uniform accounting to do this calculation, and you have to calculate the cost of capital and take that out. But that's the excess residual income being generated by the 3,500 biggest companies in the U.S., right? And that number, let me zoom in, is set to increase. It's set to increase to 1.9 trillion, somewhere around 2 trillion in 2026. That's the kind of numbers we're looking at. That is what's driving the stock market. That's why we say it's not in a bubble. It's in a boom. Now, take a look at China, because we've been talking about this for a long time. And the economic profit of all China, and that's 5,300 companies. We're throwing another 2,000 companies in there in terms of China. And don't blink, because that's it. By the way, these two charts were drawn to scale. They're drawn to scale. So, yes, if you want a reason to understand why China is in such deep trouble, it's because if corporate China, look, corporate China is very big, but what good is, think about yourself as an entrepreneur, what good is working all that hard to be, to create a $20 million company if your costs are $20 million and you end up with near zero profit? Because when you're talking about a $18 trillion economy that can produce only double digit, I mean, honestly, with an error of zero, right, in 2024, zero in terms of economic profit, that is a problem China has. And by the way, when you have that low in economic profit from the companies, that means the people working for those companies have also less chance of getting a raise, getting more income, getting more benefits. It is a depressing factor on the entire economy in a way that China has been, I'll say, hiding, not reporting, and the mainstream media hasn't been reporting. And it's the reason why Chinese tax revenue has been flattening out. Now, this is also drawn to scale. So this is around $2 trillion of Chinese tax revenue on a ridiculous level of tax rates that China taxes. Because when you look at tax rates, you have to look at all the taxes, including Social Security and housing and every way that China taxes companies and people, because it's massive. It's easily double what the U.S. taxes. Believe it or not, for all the problems in the U.S. taxation system, China's is unbelievably more. Of course, it's a communist country. You're what you make is for the people. Whereas the U.S., and this is drawn to scale, which back in 2008 was already generating more tax dollars, that number has skyrocketed to 4 trillion, to 4.9 trillion. And we're looking at in 2025, something like $5.5 trillion. So you have the U.S. economy, because it's growing, because profit is growing, and that's the measure to look at, not GDP. If the country has high GDP, but the companies are not profitable, and the people aren't able to make more money, you just have more people making more money and more companies, generating revenue, but not earning a profit, you don't have a tax base. To have a tax base, you have to have income, either at the corporate level or at the individual level. And when that's not happening, you see things like this flattening out. Now, I'm not saying they couldn't tax their people even more, but that will further stunt the economy like we're seeing right now. And that's what's happening in China. Finally, I'll say the chickens are coming home to roost on what's been happening in China. We're beginning to see just how bad things were. We've been reporting on this for 6-7 years, right? But only recently has mainstream media start to pick this up. Now, what about Russia? Now, this is another one where you can't blink. So this is Russia's federal budget revenues. These two charts are drawn pretty much to scale. You're like, are they drawn to scale? Yeah, believe it or not, the height of that second chart is about the same as the height as the other one, even the font's smaller. That's the amount of Russia's federal budget revenues. While the U.S. is at $5.5 trillion, Russia, best guess, is at $400 billion. You're looking at a fall of the Russia Federation that is tantamount to the fall of the Soviet Union. The Russian economy cannot produce the kind of tax base that Russia has been taxing, again, on ridiculously high taxes. They just raised taxes again, obviously, to fund this war that they're in. Russia doesn't have the federal budget. They don't have the tax revenue. It doesn't even come close. If you add all of Russia and all of China, frankly, add all the BRICS together with all the nonsense talks about the BRICS, Brazil, Russia, India, China, and my goodness, South Africa, I don't know how they even included that. Add all of their tax revenue together, and it still doesn't even come close to the tax revenue that the U.S. generates and can sustainably generate, because the U.S. actually charges lower taxes, believe it or not. Corporate taxes have come down since 2018. They have, right? And frankly, income taxes individually are nowhere near as severe as the total tax wedge in Russia and China. It's not, by the way, it's not even close, right? On that basis, the U.S. is in charge. So when you look at this, you're really looking at the end of Russia being a dominant player at all, because they don't have the money. And China is at the earliest stages of it, also in an economic collapse that's going to last another 10, 20 years, unless they put in some severe, massive Deng Xiaoping, like I'm talking early 1990s, 1980s regime change, which doesn't look like is happening, at least not yet. And even that regime change would have to change tax policy and economic policy at such a level that would take another 10, 15 years to catch up with all the problems they've had. So we're looking at Pax Americana in full swing at levels people have never even realized, and the mainstream media is not reporting it. Now, I'm going to say again, if you're going to troll me on this and say, oh, it's the end of the U.S., please give me some data, give me some research that backs it up, because so far we haven't seen it. By and large, on every major clean economic indicator, Pax Americana is in full swing, and the former, you want to call it Axis powers or China, are not surviving.
No, exactly. Right. And everybody, right, this is what we're seeing. And so if you look, we have picked off two companies that we think are actually pretty interesting companies that could benefit from the big trends that we see coming. Joel, let's actually go into it. Let's give everybody context on what we're looking at here with Bowman, which everybody, just for a bit of a thumbnail on this, Bowman is a company that does engineering work, right? They are the people who you come to ask, hey, I need to build build out the grid. What do I do? I need to get permitting for this. What do I do? I need to be able to figure out how to do transportation. What do I do? And that's why we think this one's interesting. Joel, let's show everybody what we're seeing here for Bowman.
Yeah, so this company that is really more engineering than it is construction, it's engineering in the construction industry, has return on assets under GAAP. This is what you see in FactSet. This is what you see in Bloomberg, whatever. These returns that are like not even 2% and 0 in 2021 and near 0 or negative in 2024. In reality, under uniform accounting, the company is more like a 5% return business that, with the boom in infrastructure and CapEx and spending that we're seeing, is seeing returns that are rising to levels that are well above where they've been, and closer, frankly, to U.S. corporate averages. Now, are they there yet? I mean, they had a good 2022, right? But they're headed that direction. U.S. corporate average is 12%. Wall Street believes they're going to get right into U.S. corporate average, a very healthy 12, 13, 14% return. And to get to the current stock price of $580 million market cap, man, this is only a $500 million company. The market's saying, okay, things are going to continue to improve a little bit beyond what Wall Street says. Now, given the boom in infrastructure, given the need for more electricity plants, more industrial plants, the reindustrialization, the supply chain supercycle that we've been talking about for really since the end of the pandemic for the last 3-4 years, right? This doesn't look that expensive. There really might be some upside here to Bowman.
Yeah, exactly. I mean, everybody, you think about it in terms of Joel, to your point, we're going to see a lot more investment, just like we talked about. Remember what slide one talked about in terms of what chart one talked about in terms of, hey, look, we are going to see a wave of investment. And what our second chart talked about in terms of we are in the middle of an investment cycle. In the middle of that, we're going to see a lot more demand for these guys. And on top of that, Bowman has done something really smart over the years. They have been a smart strategic acquirer of specialties, right? They went from, hey, you can rely on us to figure out how to lay out your electricity, to, hey, you can rely on us to figure out how to get your permitting for water, to, hey, you can rely on us to figure out how to do your transportation. So they're adding more and more things that everybody's buying from them each time. And you see these engineering firms, everybody, because there are a few that are out there. And when they get to scale, you're talking about 20, 30, 40% return on assets that you can see from these businesses that the market just isn't sniffing out for Bowman. That makes it really interesting to benefit from that big wave of investment that we're talking about. And the second company is Douglas Elliman. Douglas Elliman is a real estate broker, right? So they make money when people buy and sell more homes. And Joel, as you said, if we're going to get interest rates going down, seems like we probably might get more homes sold. Joel, let's take everybody through what the market's pricing in here and why it might be really interesting.
Now, under GAAP accounting, it looks like the company had a decent 2021 when people were doing the whole, I've got to stay home, move home, I need a bigger home, pandemic kind of, I'm not going to work the office, and then had a really bad 22 and 23. In reality, from accounting, it's a lot worse. In reality, it's a lot worse than the GAAP accounting numbers suggest, right? You're looking at a really bad 2023. Well, what happens when interest rates rise at one of the fastest levels in all of history? Interest rates rise that fast, you just don't have as much brokerage going on of homes. It just doesn't happen. And when that happens, homes, and by the way, and office, I mean, think about how office real estate is really dead still. So, of course, a company that's servicing that kind of real estate in that way is not going to have a very good year. Now, what does Wall Street think is going to happen? Wall Street thinks that this is going to rebound and get back to maybe a 4% return, 5% return. The stock market believes, on the other hand, at a $240 million market cap or $2.73 a share, that's going to be short-lived and not last. That seems a bit abysmal, meaning it's natural for the company to get back to at least break even and a low number with some, I'll say boom in housing that we might see in housing sales if interest rates are lower, because so many people have been just saying, my interest rate's so low in my house, why should I move? It doesn't make sense to move and then move into a house with a much higher interest rate. But if interest rates start coming back down to levels they were, you're going to have a housing move. So this seems like it might be a little bit still inexpensive, believe it or not. And Rob, I don't know what your thoughts are on its embed expectations and the betting line that the market's setting for Douglas Elliman.
In a normal environment, this is probably, it's a broker, right? So it's going to be a 5 to 10% return on asset business, which is not yet what the market's pricing in here. And we think the market just is totally sleeping on a reasonable recovery that this company could have in 26 and 27, just from purely lower interest rates and everything else that we're trying to do to help with home affordability. And so this is one to not sleep on because it's going to benefit from that whole entire environment that we talked about in our third chart, which is all about what happens when the consumer gets some pulse just because of interest rates. So everybody, if you enjoyed this and you want to actually get exposed to some of the ideas that we talked about, we actually have a new special report that we put out called newenergyboom.com is where you can access to it. It's a special report that focuses on what Joel talked about in terms of the idea that there are specific kinds of energy that as we're doing this AI infrastructure build out and specifically the utility company build out around areas like, for instance, natural gas and nuclear and just in general raw materials that we need to power this boom, that you have the opportunity to get exposure to. If you want to learn more about this and two of the big trends that are going to power this market in 26, go to that link below and check out. And if you like this, or maybe you want to disagree even more with Joel than you already have, or with me, possibly, though I'm generally more agreeable than Joel is, feel free to drop it into the comment section below, everybody. And don't forget to hit the like and subscribe button. That is this episode of Altimetry Authority. Thanks, everybody.